Sunday, April 22nd, 2018, Monaco 64, home of alternative economics and contrarian views. So yesterday I had a golf match for my club against another club. We had to go play somewhere else. It was a long day, 36 holes. That's why I didn't make a video, but today I'm back. Billy's back. And I want to talk about a book and link it to what's happening to the bond market right now. The book is Extraordinary Popular Delusions and the Madness of Crowds by Charles Mackay. That was written in the 1850s. I've had this book for over 20 years. Very interesting book. It's got sections. It's about all the different manias that have occurred in the past and how human nature never changes. It's one of the reasons I'm so interested in history, because once you read these books, you understand how things happen, that things go in cycles. They're not linear. So what's it got to do with the bond market? I cover the bond market fairly regularly, and for the new viewers and new subscribers who don't know, I worked in the city of London for over 20 years, and my specialty was the bond markets, interest rates. I was a futures and options broker for my clients who are institutional clients like banks, other brokerage houses, mutual funds, corporate treasuries. And yeah, that's what I followed mostly, the bond markets. I did do other markets like the stock market index futures or options on stocks. We did do some commodities, but the bulk of my business was the bond market. And I've talked about the bond market in the past. Earlier this year, I've warned about the bond market and why is the bond market so important before I go further. Well, bond markets determine interest rates. A lot of people think it's the central banks that determine interest rates. They can only control fairly, fairly effectively the very short-term interest rates or overnight rates through setting targets like the Fed funds or the base rate in the UK. But the longer-term rates like 1 year forward, or from like 5, 10, 30 year, even 50 year, some countries issue 50-year bonds, they're more controlled by the market. Of course, in the last 10 years, central banks have tried to manipulate the longer term interest rates by doing QE or money printing to buy bonds, which is, in my opinion, a very popular delusion. To think that central bankers think that they can manipulate the price of money by issuing even more money to control that price. But for the last 37 years, since 1981, bond yields in the US and Western Europe, they've dropped from historic highs. For example, in 1981, the 10-year yield was up, I think, almost to 16%. And now, of course, we're just below 3%. But it got down as low as 1.36 in July of 2016. Excuse me. So why is it so important? Because every other loan in the world is determined off the 10-year yield. All the mortgages, all the long-term corporate loans, whatever you want to call, wherever you look, it's a very important benchmark. And why is that? Mainstream economic world, mainstream financial world consider the 10-year yield the risk-free rate of return. And I put that in brackets, risk-free rate of return, because I don't think it's the U.S. Treasuries are risk-free. And the reason they consider it, though, is that the U.S. Treasury or government can always print money under a fiat money system, so they won't go bust. But in my opinion, the value of the dollar or the price of gold going up will determine whether that bond is risk-free or not. The reason why I think we've had an extraordinary popular delusion for the last 37 years is that despite the fact that the US national debt has gone from just under $1 trillion back in, let's say, 1980 to over 21 trillion now, despite that, all this flood of debts, all the other debts that have been created, corporate debt, personal debt, other countries' debts, derivatives debt, despite that, interest rates have continued to go lower. So when interest rates go low, the price of bonds go up. So does it make sense to you, knowing the law of supply and demand, that if something becomes more and more abundant, that its price should go up? No, to me it doesn't. How have they been able to keep this delusion? Well, I think it's through the derivatives market, through the futures, through the OTC derivatives. A lot of the banks, the central banks, they create this artificial demand for their paper through the derivatives market because you can leverage in it. Just like they've created an artificial supply of gold and silver to keep their prices down, because gold and silver are the anti-debt. Price of gold and silver a lot higher would basically tell the world that the fiat money system, all the government debt, is just a sham. You might argue, well, but the price of gold has gone up from 250 18 years ago to now over 1,000. So what are you talking about? But I would argue that the price of gold and silver should be a lot higher, especially silver. And to think that in 1980, gold got to almost $900, and we're only at $1,300 now, and the national debt has gone from just under $1 trillion to 21 trillion. It doesn't make sense that gold is still at $1,350 or $1,335, wherever it closed on Friday. And that silver was at almost $50 in 1980, and is now at 17. And it also doesn't make sense that the US and Europe have so much debt and their interest rates are still minimal. But I think now we could be in the beginning of a big change in the bond market. A key level in yield this year was 263, and by key level I mean if yields broke above that, that would signify maybe danger for the credit market, the bond market. The other thing as well, low interest rates and falling interest rates help, how can I say, keep the credit bubble going, because the cost of borrowing gets cheaper and cheaper. But if it goes the other way, then the credit bubble could very easily implode. So we went above 263 earlier this year. Over a month ago, we went up to 295. So we went very quickly. It's 263, 295, and it just stopped there, just under 3%. And why is 3% really important? Well, because it's the last big spike, well, kind of spike in 2014 was at 3%. And if we trade above that 3% and stay there, go to, let's say, 310, 325, that would signify the end of lower lows and lower highs in yields since 1931. 1981. And so we went to 295 earlier this year, then we corrected back down to 273 about 10 days ago. But it didn't go back down to 263. And this week it's gone back up, and we actually closed at 296, which is only 1 basis point above the 295. But markets, look at this. And the 3% is actually around 303, 304. I think 3% was the closing rate, but intraday was 304. So it's going to be an interesting week to follow the bond markets to see what happens if we're able to break above 3%. And I think this is showing as well what's happening to the bond markets is showing in the real world or in the world of geopolitics, because the biggest buyers of treasuries outside the US are China, let's say the big dollar holders like Russia used to buy treasuries, Japan. And now there's a headline here on investing.com. Just from an hour ago, it says, Treasury chief may visit China as trade tensions simmer. So yeah, the US and China are kind of in a trade war. I would say the US started it, President Trump. But why is the Treasury chief going to China? Well, China is the biggest creditor of the US. It's not China that's going to Washington, D.C. By the Treasury chief going to China, it shows me that the U.S. is worried that they're not going to buy their paper anymore. And he's trying to like stop, he's trying to tell the Chinese, yeah, please keep buying our paper. Our interest rates can't go higher. We already seen that deficits are going to go back up to like $1 trillion a year with this new tax plan. So if foreigners start dumping or not even buying treasuries anymore, who's going to do it? Is the Fed going to do QE again and make themselves look really, how can I say, stupid or show loss of credibility? We'll have to see. So, yeah, that's why I think the bull market in bonds has been an extraordinary popular delusion. There's still many of those who think that if the economy, how can I say, slows down, if there's a crisis, that people will flee to bonds and yields will go back down again. I'm not too sure. So yeah, I recommend this book. For example, I'll tell you about the sections they have about the contents. They talk about the Mississippi scheme and John Law, very interesting. The South Sea bubble, which was in the UK. The Mississippi scheme was under in France, of course. They talk about the tulip mania. They call it here tulipomania. They talk about the alchemists. I guess we've got alchemists today's as well. They talk about the Crusaders, the witch mania. Read here in the back of the book a little bit of a summary. It says, Extraordinary Popular Delusions and the Madness of Crowds. This classic catalog of some of the more outre enthusiasms, speculative, social, religious, and just plain daft, serve as a salutary reminder that the follies of mankind are not unique to the modern world, or not unique also to just one period of time. I think we're going through one right now. Whenever struck by campaigns, fads, cults, and fashions, the reader may take some comfort that Charles Mackay can demonstrate historical parallels for almost every neurosis of our times. The South Sea bubble, witch mania, alchemy, the Crusades, fortune teller, haunted houses, and even the tulip mania are only some of the subjects covered in this book. So there you go. The bond market, keep an eye on it, and I'll keep you posted about it as well. So if you enjoyed this video, please like, share it, subscribe to my channel if you haven't yet. Also make sure you click on the little bell so you get notified of my new videos, and you can follow me on DTube, Steemit, and on Twitter. And I'll talk to you later. Take care.